Businessworld Live. I'm Danny Laurel.
And I'm Jess De Los Santos. Here are the biggest stories to kickstart this trading day, Wednesday. Lawmakers are pushing for a declaration of economic emergency that's to cushion the impact of soaring fuel prices. But Energy Chief Alfonso Cusi is thumbing down this proposal.
Bloodbath at the local bourse. The bellwether index plunged below the critical 7,000 level on Tuesday on the back of incessant oil price hikes.
And the LTFRB is facing growing pressure to increase the minimum fare for PUVs. Even the airline industry is now feeling the pinch, with local carriers seeking help from the government to mitigate the effects of skyrocketing fuel prices. Philippine stocks posted their steepest loss since June 2020 on Tuesday, with the 4.3% plunge driving the benchmark equities index below both the psychologically important 7,000 support and 200-day moving average. Danny is at the Bloomberg terminal to give us an update. Dan, is it any better this morning?
Well, I have to say, Jess, that there seems to be a little bit of a glitch or delay in terms of the Bloomberg terminal because we haven't really moved yet, or perhaps market makers are really waiting to see which direction to go because it is flat right now. Okay, here we go. We are finally up by 11 points. That's up by 0.2%, 6988.94. That is 4 minutes into the trading day. Of course, this has nothing, on the back of the more than 4% plunge, as you mentioned already yesterday. And I just want to take a quick peek at which stocks seem to be pulling their weight here. And you can see a lot of the ones that were sold off yesterday being bought in, perhaps some bargain hunters swooping in. You've got JG Summit leading the charge together with ICTSI and BPI, but still sitting out this rally, San Miguel, Emperador, Robinson's Land. Quite a heavy number of blue chips here. And together with me, I'm actually joined via Zoom by Japheth Tantiangco of PhilStocks to help me hash out what is going on in terms of this volatility. Good morning, Japheth, and welcome.
Good morning, Ma'am Danny. Thank you very much for inviting me on your show.
Okay, Japheth, what is going on, please? This oil story, the fare hikes, has actually been going on for some time. And we can even say that, the war was started, or the invasion of Ukraine by Russia was started on February 24th. That had already rocked markets. Why yesterday was this such a massive sell-off? And, what are the new support levels here?
With respect to the market is fearing inflationary pressures. That's the number one problem of the market right now. Yesterday there was this rising fears with respect to Russia's oil exports being the target of the next economic sanctions. In fact, we already saw that last night, though it's limited to the U.S. for now. The U.S. has decided to ban imports of oil coming from Russia. But by the end of the day, the fear is that the Russian oil supply could be taken out of the global market, either voluntarily or either by force. And of course, once that happens, oil prices are expected to rally further. And of course, this is expected to cause inflationary pressures for us. So aside from that, we're not just, of course, oil is the number one problem, but aside from that, you also have other products. You have corn, you have wheat. Wheat is Russia and Ukraine are both exporting heavily wheat, while Ukraine is heavily exporting corn. And if you're going to look at the PSA's data, Philippines is an importer of corn and wheat. So if the supply of corn and wheat are going to be disrupted, in the global market is going to be disrupted because of the ongoing war between the two, then of course it's going to increase, it's going to push its price upward, which of course will add inflationary pressures to the Philippines. If you're going to look at the BSP's projection, if oil prices hit $120 per barrel, they expect inflation for the year to average 4.4 to 4.7%. If you're going to look at inflation right now, for this year we're averaging 3% so far. So from 3% to 4.4 to 4.7%, it means that moving forward, if this is going to come to pass, then inflation is going to take higher jumps moving forward. So inflation is the main problem of the market right now. Adding to that is, of course, the worries that because of these rising commodity prices offshore, import costs going to rise, and with the rise of import comes higher trade deficits, which is of course going to weaken our external position. We're already seeing the anticipation of that right now in the currency market. You're going to look at the peso; it's already depreciated below $52 per barrel, before below the $52 pesos per dollar mark. And of course, the decline in the local currency is also negatively affecting the local pulse. So these are the factors at play right now, which is causing the bearish sentiment in the market.
Jafet, I'm sure you're watching the oil story very, very closely. It's now 130 a barrel. I mean, how much higher can this actually go? You already mentioned that, it's likely that oil from Russia will be taken out of global supply. Is there even a level here that you can already price in?
Well, to be honest, we don't have any specific level. We're not yet looking at any specific level. But moving forward, if this tension between Ukraine and Russia continues, then of course it is, and of course if other countries will follow suit, with the U.S. move to ban Russian oil imports, then of course oil prices are expected to surge even higher. Well, if you're going to look at Russia's projection, which is quite grim. Russia's projection is if we're going to take out their oil exports out of the global market, oil prices could reach $300 per
Oh,
barrel.
wow.
So that's really horrible, and
Wow.
we're hoping it doesn't reach that. But that is something that we cannot discount. If this oil disruption really happens, or if this oil disruption really pushes through, and it's really problematic for for the global market, for the local economy, and of course for very own local equity market.
What is the support level now in the short term before investors start bargain hunting and swooping in? And do you see that already happening?
For the market's technicals, we're looking at 7,000 to 7,100. So
Okay.
that's the support range that we are seeing right now. If yesterday the market closed below that range, so we are observing today's performance. If it is able to get back above that said range, then that will remain as its support. However, if the PSEI declines further, the next support that we are already seeing is at 6,600. So
Okay.
our advice to investors who are trading the market, we advise that you watch out, wait and see first how the market is going to how the market is going to trade moving forward. If it gets back above 7,000, or if it regains its position at the 7,000 to 7,100 range, then you may accumulate cautiously. But if it's not able to do so, then wait for 6,600. Unfortunately, right now, chart-wise, things are still bearish. The market has already gone in just in this week's trading. The market has already gone below the 50-day and the 200-day exponential moving average. If you're looking at the MACD, it's declining. If you're going to look at the RSI, it hasn't hit oversold levels yet, or it hasn't hit oversold territory yet. So it goes to show that there's still, at least chart-wise, there's still room for downside.
Okay, Jafet, one sector here, the miners, having seen quite a rally even before this war had been happening. How much further can they go? Nickel now past $100,000 a ton.
Well, with respect to the mining sector, yeah, it's becoming one of the favorites right now amid these challenging times because of the rising prices. I mean, well, first nickel. That's because Russia is exporting. Russia plays a significant role, or at least it's an exporter in the global market, an exporter of nickel. So again, because of the worries over the sanctions, Russia's export to the global market of nickel being cut, so that's causing nickel prices to surge. And of course, investors are also running towards safe havens, and that includes gold. So you may want to look at stocks that are mining such nickel and gold. If you're going to look at our nickel miners, I'd go technically speaking, I'd go for FNI for Global Ferronickel. Nickel Asia, if my memory serves me right, it already hit an all-time high yesterday. So we have to watch out further for that. We don't have a clear resistance for that yet. For gold, you may look into PX mining, and you may also look into Atlas. So those are the miners which we expect to benefit this year,
Okay.
sentiment-wise, and even in real terms with their financial performance amid the rising prices of nickel and gold.
Okay, you can see that on my terminal here, year to date, mining and oil counter up by 50. Actually, it's on the right side of the terminal here. If the producers could show that on our screens. Okay, there you have it. The mining and oil counter for our viewers here, 53% jump, led by Mark Ventures up by 108.55%, followed by Nickel Asia and Global Ferro Nickel. Still a lot of volatility here, but thank you so much for weighing in those insights, Jafet Tantiangco of PhilStocks.
You're very much welcome.
Now, still on soaring oil prices, House Ways and Means Committee Chairman and economist Joey Salcedo wants the President to declare a state of economic emergency. But Energy Secretary Alfonso Cusi says it's not yet necessary. Mobile journalist Pamela Vasquez tells us why.
Energy Secretary Alfonso Cusi has finally spoken out about the brewing oil crisis and says a state of economic emergency is not needed at this point.
Even when you declare an economic emergency, what do you do during the economic emergency? Ganun pa rin eh.
He countered House Ways and Means Chair Joey Salceda, who's been pushing for President Duterte to declare a state of economic emergency in light of the war in Ukraine. Doing so will enable local government units to tap their calamity funds to provide relief to jeep and tricycle drivers, as well as farmers and fisherfolk. Calls to suspend excise taxes have also been growing, and both houses are in recess right now. Salceda insists President Duterte should call for a special session of Congress by March 15.
Halos lahat po ng forecast ng JP Morgan, ng mga stratas, ito po yung mga consensus, baka umabot ng $185 yan. At ang presyo po ng diesel, baka umabot ng 136, yung gasolina 145 at yung kerosene 129.
There's also talk of amending the oil deregulation law, but it isn't expected to happen until a new administration comes in. For now, Cusi says they will instead double the fuel subsidy program known as Pantawid Pasada. But transport groups says it's not enough. They'd filed petitions calling for a fare hike which Salceda supports.
Since 2018 pa, 9 pesos na tayo. Kailangan po ng shared sacrifice.
Asked whether he thinks local pump prices could hit 100 pesos a liter given the ongoing conflict, Cusi says it's possible. Mobile journalist Pamela Vasquez, We Are One News.
We'll have more stories when Business World Live returns. Stay with us. still watching Business World Live here on One News. I'm Jess De Los Santos.
And I'm Danny Laurel. Transport groups are intensifying their calls for a fare hike as prices of fuel increase further.
But the LTFRB says that based on their computation, only around 1 peso could be added to the current minimum fare of 9 pesos. Transport groups are pushing to increase the minimum fare by up to 6 pesos, but LTFRB Chairman Martin Delgra says they could only add around a peso based on recent changes in fuel prices. The decision for a 10 peso minimum fare is now up for resolution.
We want to be very cautious here so that we'll be able to balance the interest of the driver to keep providing public transport in a sustainable manner, while at the same time not having to unduly burden our commuters.
Finance Secretary Carlos Dominguez is not expecting the current oil crisis to last long, noting that the Philippines is not directly affected by the Russia-Ukraine war.
However, he admits that the country's economy might become a collateral damage of that ongoing war. One News' business editor Regina Lay with the details.
Amid growing calls to suspend fuel excise taxes, Finance Secretary Carlos Dominguez III is taking a measured approach. He told President Duterte at Monday night's cabinet briefing that he doesn't think the oil price issue brought about by the war in Ukraine will last long.
There may be some lingering effects. Philippine economy will likely be collateral damage. It is as if we are hit by a ricocheting bullet.
And that's significant because President Duterte largely leaves economic decisions to him. He assured the president that the government will be able to keep inflation to within 2 to 4% this year. Dominguez also told the cabinet that the Philippines is well equipped to weather this crisis, given past experience.
We have seen similar crises in the past, such as the Gulf War in 1990 and also the first Russia-Ukraine conflict in 2014. And we have weathered all of these crises very well.
Back in October, the Finance Department already shot down the idea of suspending excise taxes. At that time, the Philippines was already suffering several weeks of oil price hikes, but the Russian invasion hadn't happened yet. The DOF argued that we will lose more than 131 billion pesos in revenues if they suspend excise taxes. And that's money that was being used for health care and COVID-19 recovery measures. Because of the extra expenses from the pandemic, the Philippines recorded the largest ever budget deficit last year. And the bigger the deficit, the more the government has to borrow in order to fund programs. Regina Lay, We Are One News.
While the finance chief believes the ongoing crisis won't last long, it's definitely far from over. To get his thoughts about how much more impact the country should brace for, we have Professor Emmanuel Leyco, economist and president of the Pamantasan ng Lungsod ng Maynila. Good morning, Prof. Leyco. Thank you for joining us today.
Good morning, Jess, and good morning, Danny.
All right,
Thanks for inviting me.
Thank you for joining us again. You've heard Secretary Dominguez in that report saying that he's not expecting this crisis to last long and saying that while we will be a collateral damage from that ongoing war, he says that we actually have enough tools to weather the storm. But what are your thoughts on that? How long do you see this extending?
Well, the U.S. is already talking about withdrawing any purchases from Russia. There is already talk about Ukraine government in exile. So it doesn't look like it's going to be resolved in the next few days, next few weeks. Perhaps it will take months and even be on a prolonged mode. So we need to prepare for a midterm and even long-term displacement that can happen in the economy.
Okay, sir, let's talk about the fuel problem first of all. No, we just had an analyst this morning saying that this might reach $300 a barrel should this, continue.
That's also what Russia is threatening.
That's also what Russia is threatening. And sir, we have on the other hand, the DOE saying that the sunset provision of the automatic suspension of the excise taxes is lapsed. So they need to. There's not actually this provision wherein we've already breached the $80 a barrel. What more can we do? The government has directed these funds of the excise taxes to help with the recovery of the pandemic. How can we balance between that funding and protecting the consumers?
Well, first, speculations on the price of oil hitting $300. I don't think that is a remote idea, given the intensity of what is happening now between Russia, Ukraine, and European countries and the US. This is like all the global players are in this issue already. And this is not just a small issue. People are now talking about economic and financial instruments being weaponized against each other. So, for example, when they try to take out Russia from the SWIFT network, that will be felt by the Russians. But how can that play out when the European countries continue to source their wheat, source their natural gas, source their oil from Russia? Somebody has, or they will have to find a way to pay each other. So coming out of the financial network, they will have to find another system by which to settle their obligations. So that will take some time, and that will have some disruptive effects on trade and on the prices of these commodities that are being traded. Now, in the Philippines, supposing the price of oil hits, well, I'm not talking about 300 yet, but say 150, 200, that will already be devastating enough for the economy. We are an importer of oil, and with the dollar-peso exchange moving to our disadvantage, this can create major disruption, major trouble for a country whose economy is just beginning to recover from the pandemic. So I believe things are going to get worse before it gets better, and therefore we need to be on hand, take stock of what we have right now, what we can do, what financial instruments, what economic instruments can we employ so that we will be able to mitigate to some manageable level the impact of the Russian, Ukraine, and the European countries, the NATO countries in conflict with each other.
Now, Prof. Leco, speaking of financial instruments, a proposal, at least calls from some members of the Congress to declare a state of economic emergency has already been put forward here. Is that a viable option at this stage? You have the Energy Secretary saying it's not necessary at this stage. Your thoughts on that, sir?
Well, I think what is more important is to bring the legislators back. Look at the excise tax and even consider value-added tax. Look at our budget and see if there can be some realignments that can be made or some changes that can be made. Remember, the General Appropriations Act is already a law, so it will take time before it can be changed by the legislators. So they will have to come back. Now, do we need a state of emergency? We need a state of emergency in order to facilitate easier movement of funds. However, if the funds are not forthcoming, a state of emergency will become meaningless. So let's start with the legislators coming back. Let's start with the legislators doing the budget, refocusing our budget, and pay special attention to what is happening right now in the economy, in the Philippines, and in the international setting or the global market.
Sir, I'm going to put together a couple of questions before we let you go. First of all, is there anything we could have done better to prevent this? Were there any measures that we could have done, maybe regulate the sector better before this happened? And also, second, do you agree with Secretary Dominguez of the Finance Department saying that this crisis won't last long? We've seen this issue in 2014. We weathered the Asian financial crisis, et cetera, et cetera.
Well, first, with due respect to the good secretary, uh, the conflict now between Ukraine and Russia is very different from what it was in 2014. There were no movements of troops. There were no actual bombings. There were no shooting as intense as happening right now. So I believe that this is very different from the previous conflict. Also, they're talking about government in exile. When they say government in exile, they're talking about government for the long haul. This is not a government in exile for 1 week. This is a government in exile for quite some time. Also, the nature of the conflict right now had already mobilized different forces. The European countries are already mobilized. Unfortunately for them, they had not found a substitute for what they were importing from Russia. So that might be an empty statement for them to say that, no, we are going to sanction Russia. So where are they going to get the wheat? They're going to sanction Russia. Where are they going to get the natural gas? Where are they going to get the oil that they used to get from Russia? Even the U.S. The U.S. is a major oil producer, but they are a net importer of oil. So they will also be hurt. Now, if we talk about what we could have done, of course, it's always, it's not a good idea to talk in hindsight, but it's always good to consider what we could do moving forward that we should have done before. This is energy policy. You cannot talk about oil without talking total energy requirements of the country. You have to have a plan. And these are the types of disruptions that our energy policy should have been preparing for. And our energy policy should also not exactly duplicate, but also complement what is our overall economic plan. If our economic plan would move forward and say we want to see 3, 4, 5, 6, 7% GDP growth rate, what would it mean for our energy requirements? So if our energy requirements would mean that we have a stable supply of oil, a stable supply of natural gas, and a good amount of energy efficiency measures, that should be part of the plan. And it doesn't look like it was placed before this happened. So right now, I think moving forward, we have to take into consideration overall the energy policy of the country.
Okay, so sadly, war had to be the catalyst for this to happen. But as you mentioned, there's still some hope there. Hopefully, this does spur some, investments into our energy security. Thank you so much, Professor Emmanuel Leco, President of the Pamantasan ng Lungsod ng Maynila.
Thank you very much for having me back.
Here are the other headlines we're keeping our eyes on. The Philippine Star reports that local airlines are now seeking government assistance as prices of fuel continue to soar. The Air Carriers Association of the Philippines is calling for a reduction or non-increase of government-imposed fees and charges to mitigate the impact of rising fuel prices. ACAP Chairman Bonifacio Sam said jet fuel prices, based on the means of Platts Singapore, have been continuously rising since December last year, from $79 per barrel to $124 as of March 3. Airlines are currently allowed to collect fuel surcharge to partially recover losses from the soaring fuel prices and the weakening of the peso against the dollar.
The number of registered OFWs declined by nearly a fifth in 2020 amid the peak of the COVID pandemic in many parts of the world. The ranks of OFWs dropped by almost 19% from 2.2 million in 2019 to just about 1.8 million in 2020. Economists largely blame this on the pandemic as many countries implemented strict lockdowns and closed their borders to contain the spread of the virus. The Labor Department also said more than 800,000 OFWs returned to the country since the onset of the pandemic.
And that's a first look into the business day this Thursday,
March 9.
March 9. I'm Jess De Los
2022.
Santos.
And I'm Danny Laurel. Mask on, wash hands, stay safe, Philippines. We are One News.